Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? It's Phil Tarrant here. I'm the host of the Smart Property Investment Show, but you probably know that if you've been tuning into this for however long we've been doing it, and you might have heard me talking about it. I don't normally pump my own tyres up too much because it's not the way I operate, but I like to pump the tyres up of the team who are behind the Smart Property Investment Show. And shout out to them. 10 million downloads just recently. You might have seen some stories about this, but that's 10 million times people have downloaded this podcast to learn about property investment. So hopefully people are making more informed investment decisions by doing it. If they're not, well, something's gone wrong. But I think 10,000 downloads pretty much says that something's working. But if you'd like us to do more, get in touch with the team, editor at smartpropertyinvestment.com.au. Always happy to change what we're doing, how we're doing it, why we're doing it. Give us a hard time if you feel appropriate. Give me a hard time if you feel appropriate, and tell me I don't know what I'm talking about. That said, I've never claimed to know much about property. What I know a little bit about is how to talk to people about property investment, and it's fortunate that I get to speak with a whole bunch of different people. And if you're tuning in on the internet, how you going? Welcome to the show. We speak to property investors. That's cool. I like those chats. And the person I was speaking to today, the first time I spoke to him actually, was as a humble property investor rather than a property professional, which is the other side of the ledger of people I chat to. So these are buyers agents, lawyers, accountants, financial planners, conveyancers, pest and building inspectors, lenders, brokers, all those people that help Australians. They're the A team that support Australian property investors do what they do. And it's cool. So we cover a lot of ground. We want to keep doing it. It seems to be working. We want to do more. So if we want to step it up, change it, you let us know. One person who's not scared to give me feedback is Sam Gordon. He's from Australian Property Scout. Director, founder, what do you call yourself?
Yeah, all that stuff. I don't know. Director. Just call myself director.
The director?
Yeah.
Director of Australian Property Scout. Was once upon a time a property investor. Farming rabbits.
Yeah, that was it back in the day.
Farming rabbits back in the day. And you found a natural home in property investment,
yes,
haven't you?
I certainly have, mate.
Yeah. How's business? What's going on?
It's good. It's good, mate. Yeah, it's good. Firstly, man, big congrats on the 10 mil downloads.
That's crazy,
wild.
isn't it?
That's crazy, man. 10 mil.
I sit there and just go,
that's insane.
It's mad, And but it's funny, because people stop me on the street and go, "Oh, do you do that podcast?"
Yeah, everyone knows you, man.
Yeah,
Everyone knows you.
Yeah. I was at Aric the other day and someone stopped me wanting to get a selfie. I was a bit embarrassed.
Really?
Yeah. It's not so, I'm not an influencer. I've never. I don't know what you call it. Maybe I'm an accidental influence. I'm old school. I'm old school. I don't want to be on the social media selling my wares and telling you what I ate for breakfast and how many reps I did at the gym. That's not me. I like to.
No, you've done well, mate.
I like to stay in the shadows a little bit. But yeah, thanks, mate. Yeah, thanks, mate. But
awesome.
That said,
yes.
Last time we had you on, I think you were the number one downloaded podcast for 2022 calendar year.
Yeah.
So, mate, you're part of the $10 million downloads. People tuning into you.
Thank you,
story.
Mate. Yeah, mate. No, it's good. I appreciate it, mate. It's always great jumping on and sharing the story and the insights of what we're witnessing out there and everything at the moment as well. So I know you'll give me a bit of stick over that New Year's, the year in review and coming in at number one. But no, mate, we always get on here and have a laugh, and it's good fun.
One thing I've worked out, probably the longer you're in it, it's harder to get wrong.
Yeah,
so if you had 12 months of a podcast with you, there's probably a good reason why it's number one, right? Rather than the person only had a month in the market. But it's all about timing the market, isn't it?
It is.
It's all about timing the market,
Mate.
even timing podcast market. I've got some notes here as well, which makes me nervous to talk to you about today. Why are stock levels so tight? ? And how to bag the best deals. Can you bag good deals at the moment?
You can. You still definitely can.
Yep.
It's just a lot harder. The stock levels are super tight. There's a stat that got thrown out, I think it was about a month ago. Stock levels across the country, they got released from year on year, from 12 months ago. We're down. The lowest city was down. It was still over 20%, and a lot of them were still over 25% stock levels from 12 months ago.
What's a stock level? Let's go back to basics.
Yeah, back to basics. Stock levels is essentially a property that's for sale on market at any one time.
Okay.
Actually really, really key example at the moment and a city to have a good look at. No, I don't give you too much normally on prime locations. But you have a look at Perth, historically, sits normally around about 11, 12,000 listings at any one time. If you wind the clock back to 2013, 2014, when Perth had that little mini boom, they were sitting around 8,000 listings at the time. This is for houses on the market at one time, just over 8,000. We're currently at just under 4,000, so about 3,900 listings. Just showing how tight. That was boom times back then. We're at half of that now. It just shows how crazy it is stock. And that's just one city. There's a lot of other locations and regions and other cities that are super, super tight. Like I said, it's literally every capital city is more than 20% down from 12 months ago.
Year on year.
Year on year, yeah. So it's wild.
Why does that matter? It's a real simple question. People always talk about stock levels and prices and supply and demand and all this stuff. Why does it matter?
Not enough property to go around. There's people out there, still a lot of people out there looking to buy at the moment. And there's not enough property to go around. So when there's still people looking to buy, but you literally have a fifth less on market or a fourth, literally a quarter down on ordinary levels or more, it's just been getting exacerbated every year as well. Kind of started back in 2019 and 2021 too, and then we're in a really, really crazy period of it now. So there's not enough stock to go around for how many people are looking to buy. And this is why a lot of people are saying, shouldn't prices be coming back with interest rates where they are? They can't come back if there's no stock coming to market to get hammered as well. So I think a few of the big cities will change, like a few of the unaffordable ones, as the interest rates have some more time to take effect. I think it will change. Yeah. But a lot of the market is going to stay pretty tight for a while because there's not that much incentive to bring new stock. Like developers, you look at developers even just from their standpoint, why are they going to bring stock to market? Prices have come back. It costs a lot more to bring a product to market. They're not going to bring it in. You got all these new population growth coming in as well. And it's just, there's not enough. Yeah, essentially there's not enough there to go around for how many people are looking to buy. So that's what keeps the pressure cooker on pricing.
So you're saying it's uneconomical at the moment for developers to develop, so they're happy to wait in the wings and keep their powder dry. That's right. That's cool.
And there's a lot of home buyers as well.
A lot of home buyers.
They can't get the finance anymore, and build prices have gone up 50, 100,000, maybe in a lot of cases more from when they bought the block if they bought it 2 years ago, and it's taken this long to register. No, they can't build.
So if there's less properties, I'm going to be really, really simple here.
Yeah.
If there's less properties available for sale, and there's people that still want to buy properties, even though it's a lot more expensive to hold a property and there's less people wanting to buy because they're constrained with interest rate repayments, there's still more people that want to buy than what there is properties available, and therefore prices aren't crashing.
Yes.
If not, they're at least holding firm. And if you have a look at some of the banks have come out last week or so, they reckon we're going to get 6% growth or somewhere the next year, right? Is that what you're reading? Is that what you're seeing?
Yeah, so I think that's as a minimum, especially for some of there's some cities that this year will do 20-30%. Like no questions. There's some markets
that's impossible.
Sorry?
Where it's impossible. Where?
Mate, let's do a review at the end of the year.
All right.
I gave you a little hint at the start of the app, but there's some wild spots. You even look at like a lot of the regions as well. The actual build prices in those areas are significantly more than capital cities because they're so fewer trades in those areas and material shortage and getting the materials there as well. So literally, it's costing now a specky build's $350K. You're buying the land, minimum 150, 200 grand as well. It's just setting these new floors everywhere around pricing, which is just pushing it up. Then you've got a super condensed housing market, no stock on there, people moving in for the jobs. I guarantee you there will be a lot of locations do over 20% this year.
So there's a big argument at the moment that people are having that's saying there's more stock coming on the market, mainly driven by investors who can't afford to hold properties that they bought over the last couple of years. Now they've got the realisation that interest rates are normally about 5 to 6%, not at 2%.
Yeah.
So they're flooded the market with stock. And I think Ipswich and Logan, by memory, were only recently touted as stock levels are increasing higher than anywhere else. So I get those numbers right.
Yeah.
So are you seeing this, or that's just a very isolated phenomenon?
What you got to remember is these are coming from where there's no stock. So from no stock to, yes, stock levels increasing, it doesn't mean there's enough that it's definitely, in my opinion, not going to crash the market. I think a lot of these markets, and I do agree with those areas with a bit more coming on there as well, we will start to see plateaus, but at the same time, there's not enough coming on as of right now to really cause that big dent. There's definitely areas to be wary of, and that's why I think it's really case by case in this, and you've got to be really selective with your locations. But yeah, man, like in those, yeah, that's a big thing with those. They're coming from like historic lows of essentially no stock to now stock is coming on. But yeah, it's really assessing where is still got enough in the tank, still super affordable, and the stock isn't gonna increase, overly from that end because they're starting from such low points. So the unaffordability level in those areas for those investors where their yields may not have moved too much, maybe a little bit, but the interest rates had grown so much, especially people who bought in the back end of that COVID boom. They bought in at the peak, so their debt level is still very, very high. Yeah. It's those guys that will start cashing out. But
yeah, well, the argument there is they're saying that's the investor hotspot. All the investors are in there, and Ipswich, to be fair, was ranked really well in our Fast 50 report that were released recently, which I think you were involved in. Yeah. But to the point is, if it goes from one property being available for sale to 10 properties being available for sale, that's a huge percentage increase.
It is. It's 1,000%.
It's 1,000% increase of stock on
9
market.
Properties,
Yeah, so there's always a story behind the data. And
Definitely.
as a property investor, and that's what you do for a living, you've got to interrogate the story, and you go, oh, yeah, it's not that bad. Like, it's a nice headline, right? Yeah. But if it goes from 1,000 to 10,000 is when you start going, well, hang on a second, there's a pretty bad, big, significant problem here because there isn't the appetite. So it's just absorbing a lot of the needs for property in those areas. So that doesn't mean that Ipswich and Logan are a bad place to invest in. I don't know if you invest in there, do you?
No, not anymore. No? We did really well out of there pre-COVID and during COVID, but no, we don't anymore.
Yeah, so this is the science of stock levels, and it's easy. It's an easy thing to talk about, right? What stock is available, and you're saying that's 20 to 25% down from last year with all capital. So what's it like regionally? Similar?
Regionally, yeah. If anything, it's tighter. So it's tighter regionally. A lot of people holding on to property, they're not actually trading it because rents have been booming a lot as well. And for people who are home buyers, like actual homeowners out there as well, for them to trade out at the moment, it's very hard for them to essentially trade up as well as rents are super expensive. So a lot of the time people might sell something, rent for a bit to try and find their home. Because vacancy rates are sitting under 1% in most of the areas, under 0.5% in a lot of them, there's no, like they have to pay a premium for the rental and have to fight for it as well. So a lot of them are holding, staying put. So it's incredibly tight, and it's really leading to this next phase of a lot of regions that haven't seen a boom in a very long time, really shaping up with a really tight, strong housing market.
And it's crazy, right? Because on one hand, you hear these stories of going, interest rates are dire, people can't afford their homes, and externally outside of Australia, there's certain people who have always pointed the finger at the Australian property market saying it's a bubble, it's overpriced, it's all going to collapse by 40%. So then you start seeing these signs of accelerating, inverted commas, a collapse, right? Interest rates going up, normal, all this sort of stuff, people struggling. But on the other side of it, people like you and the banks and other people saying, well, there's going to be price growth. And everyone's sitting going, well, what? How? Like, so this interest rate stuff's got no bearing at all on Australian property markets. Now, it does, absolutely. But you got to remember, you got to view it within the lens of a handful of people it is significantly impacting them. A lot of people, it is impacting them. However, prices aren't dropping. So why is that? We should talk about that. We'll just go to a quick break. Back in a moment. Were you a Scout as a kid? Scout's a good name. I like Scout.
Thanks, man.
Yeah.
No, I wasn't a Scout, though.
Was it hard to come up with that?
It was hard. Like, a few of the different names I wanted to come up with were taken. So I was kind of jotting around a lot of different things, but yeah, came up with that. And I really love it now because we're Australia-wide. We source wherever we think is the best locations to invest in. So it's good. I enjoy it. I like
scouting. Scouting's a very positive word, right?
It is.
And scouts in the military, not scouts like a scout in the army, for example, they're normally your fittest, leanest, angriest, most aggressive person out there sort of at the front of the pack finding the way, right? I guess that's probably not that dissimilar to finding property.
It's pretty much us as buyers agents in a nutshell. It's how we operate. So
you get shot because you're the first one out, right? No. You get it wrong, but
that's it.
But we're chatting about before the break is with all these headwinds, which are, to be fair, the headwinds facing property in Australia are largely around finance. Everything else is probably a tailwind, right? Yeah. And it's really liquidity and access to finance, which is really holding back the accelerant factor of driving property market in Australia. And there's a lot happening. Let's talk about finance for a moment. What are you seeing on with your clients? Are they property investor clients? We're not talking owner-occupier stuff to show for property investors. how much of a headwind is access to finance from slowing down their investment journey and buying property?
A lot of the guys we're working with, we're re-strategizing their portfolios. So, a lot of people, we were planning for different things that we're going to put into effect around 2024 or back end of this year going into 24, knowing that's when we're undoubtedly going to see some rate increases around that time. We had to bring a lot of that forward with rates increasing so rapidly in 22. So a lot of the techniques and the strategies and the different lending scenarios that you can push a portfolio through, we had to bring that forward for a lot of investors out there and a lot of clients. And so this is what I had to work through within my own portfolio when I built it as well, because I built it on a very low income when I built mine originally. So I essentially, we have to work and strategize with these guys on, okay, well now you've hit a debt ceiling, now you've hit essentially like the DTI ceilings, and you're capped with servicing. These are the different routes as to moving forward. And you and I, funnily enough, before this, were chatting about offloading deals that have seen significant growth, and assessing those in the portfolio, and do they actually have any more room for growth in the next 10 years? It's had an amazing 10 years. Has it got another amazing 10 years in front of it? If the answer is no, you're better off selling, getting the debt back, clearing a nice profit, actually banking a profit, then potentially moving that into a different entity and a different finance structure to be able to move forward in that different avenue. And that's what we're going through with a lot of investors. So a lot of people are getting stuck, but there's almost always a workaround. You just have to have a good look at the portfolio and figure it out. It's never straightforward. Almost everyone hits a roadblock and has to take a step back. I was exactly the same. I hit 7. I was stuck for a year until I figured out how to move forward. And to move forward, I had to take a step back and then work those different avenues. And it's essentially just a lot of people now going through that journey themselves. But I actually love selling down at the right times. When you sell down, you clear debt, you bank a profit, like it's actually there.
Well, you get a double whammy there.
Yeah.
And what Sam's talking about is if you buy a house at a point in time and you sell that same house later for a profit, that means you get that money back.
Yeah.
But what you also get back is debt serviceability.
Yes.
So that debt goes away. So if you're tapped out and the bank won't lend you any more money, excuse me, if you sell that property and you remove that debt, you can go back to the bank and say, hey, look, I've got more cash now to buy something and I have less debt.
Yes.
So you're a more attractive borrower because you probably are going to go closer to meeting their serviceability requirements, or it could change the type of property you can buy from a property worth 300 grand to potentially probably worth 500 or 600 grand. So,
or you might sell a property you bought for 300, you might sell it for 6 and then get the debt and the cash back and be able to go bang out another 2 or 3 back at that lower purchase price, but in different markets that are earlier in their cycles.
Yeah, and that's the point. You get into the cycle at the right time. So don't hold on just for the sake of holding on. Not all properties grow at the same speed in different markets. And I'm going to do a smart property investment show on it soon. We're offloading some properties in the western suburbs. We're selling some properties in the western suburbs of Sydney. These things have 300% growth, right? Like, all right, I'll take a check.
Yeah.
Thank you. Get rid of the debt. Get rid of the headache. Window.
It's not going to happen again. The next 10 years, it's not going to produce the same results.
I don't think so. But,
well, maybe we'll be proved wrong.
But you sit there and just go, so one of these properties I think we bought for 230 grand. We're selling it for 730. People are going, what, in 10 years? That's impossible.
Yeah.
There's no way in the world that's going to be the case. But you sit there and go, well, that $700,000 property in 10 years' time is probably going to be worth over $1 million. You go, no way. No way in the world. But this is the point. Property isn't collapsing in Australia. And we're talking about this potential for growth, right? And we need to have a chat about what's going to be accelerating that growth. But, we originally started this conversation around stock levels being tight as an enabler for holding prices firm. It's absolutely high school supply and demand. But I've got a report here from PEXA during the week. And interesting, again, there is always clues behind the numbers. And this says here, amidst the backdrop of continued, there's obviously a correlation between stock levels and settlements, right? If there's less properties to sell, there's less settlements, right?
Yes.
So it says, and I'll read this out, and you can probably go and find this online. Amidst the backdrop of continued high interest rates, property settlement volumes were down in the financial year ending 2023 compared to the record highs of 2022. But green shoots appearing in the second half of the financial year show positive signs of recovery, is according to PEXA. PEXA's 2023 Property Insights Report, Sam, it said it found more than 665,000 property settlements were nationally recorded in FY23. I wonder how many of them a buyer's agent was behind. That's what I really want to know. PEXA, if you're listening to this, PEXA, how many of them had the hand of a buyer's agent? Because no one knows. No one knows.
No one tracks it.
And I think PEXA does 80% of all property transactions now happens through PEXA. So if you've got a percentage of that, you're probably going to say that's probably universally what it is, right? the 665 in FY23. That's 18.6% lower than the previous boom year of FY22, which was 7,500 properties, right? So you're sitting and thinking, property's going backwards, right?
Literally, there's 20% shortage.
20% shortage. So it correlates with probably stock on market.
Yeah.
However, this is an important point, but that is still 11% higher than immediately prior to the COVID pandemic of 2020. So people are going, the settlements are all the way down. No, they're a lot higher than what they were.
Interesting.
Back in before the COVID pandemic. So to give you a sense of how it all works. So this says here, this was driven by a soft first half, with all states recording some shrinkage. However, settlement numbers recovered from March 2023, which was only a few months ago. Onwards in the financial year finished strongly, with more than 66,000 property settlements recorded in the month of June, up from 58,000 in May and 48,000 in April, signalling a rebound in settlement volumes. So there must be more stock coming on market, or there must be more people who are buying property in order to show settlement numbers going north.
You know what I think is going to be a very interesting thing to watch play out?
Yes.
If you don't mind me changing tack for one sec.
Absolutely.
Talking about population growth, right? Because we are starting to see a little bit more in some areas, but you look at the population growth, especially that's being forecast and that we know that is coming through. Let's say there's people like where stock starts coming on. Let's say you're like your Ipswich and your Logan, just for an example.
Yeah.
A little bit of stock starts coming on. So people who've been renting for a few years that missed out on the boom, and now all of a sudden they're able to buy. Maybe the market's come back about 10%, right? So all of a sudden they're not paying the highs, and their rents are increasing. So now they've got the opportunity to jump from a rental into a property and actually go and purchase that stock, right? And purchase that property.
Yeah.
Especially when there's increased demand from a huge volume of skilled migrants coming into the country. They're talking about 350 to 400,000 a year for the next 2 to 3 years. If they're coming in and then eating up the rental stock and pushing up those rental prices, those people that have been there renting for a few years and they're going up, but the sales stock is sitting there a little bit more starting to come on. They can pick it up a little bit cheaper than they could 12 months ago. You're going to see a big shift of these people moving into the sales side and actually buying those and eating that up. But then the rental market's just going to keep getting tighter because these investors, they need to sell out because they can't, especially if they bought in at the back end of the boom, they paid the premium, they can't afford the debt. They're selling that investment stock, which is driving down the rentals, right? And then you've got these people who were renting and they're buying the investment stock, but all these new migrants are coming in. What's that going to do to keep pushing? That's just going to keep pushing up the rental prices, right? Because it keeps putting the pressure on the rental stock that is being depleted by these renters buying that stock. So it just starts going in this vicious circle. And the trickiest point and the trickiest part of it, developers aren't bringing stock to market at the moment, like we spoke about before. Sales pricing has come down. Build cost to complete has gone up. It's the same for all product and every aspect of developing at the moment. And then you've got a lot of actual home buyers and whatnot as well who might have bought land, but they can't afford to build because prices have come up. Maybe vals are coming in short as well because, build prices have gone up, but maybe vals are coming in short, so they can't actually get it to complete. What you start working in is like this vicious cycle of where people start making that jump, but then the renters keep coming in from this migration boom that's happening as well, which we need because we've got this massive skilled labour shortage, but it just keeps propelling that housing market like that as well. And I honestly believe that's what will keep the floor, even under the expensive, unaffordable areas. I think a level of a floor will stay under that. But these affordable areas that have room to grow, if their rents are still shooting up and all these people are jumping in and buying that sales stock, it's just going to keep. I honestly don't believe the proper housing shortage and that stock shortage, I don't think is going to ease for another 2 or 3 years at least, especially because of this population, boom that's coming in.
Well, you think, at a supply side, you point to all the reasons why supply probably won't keep up with where it needs to be. I don't know the numbers, but already they're saying that we are so many tens of thousands of properties short for the current market we have, right?
It's over 100,000.
100,000.
Yeah.
So I'll need to check those numbers. But so you got the bureaucratic red tape. It's hard to develop, and the government doesn't make it easy.
Yeah.
I know they're trying to do it easier, sort of compliant development stuff in certain states and all that. It's still hard. It's a headache. I don't know anyone that has an easy job developing property to make accommodation and make it more affordable, right? So it's a failing of the government in some regards, right? The current federal government, just say, was a legacy of the previous government, so they're working on stuff. But even now, you're hearing stuff coming out of the Victorian government saying that they're considering this freeze of rents for 2 years, right? So, so back to your point, property investors who provide 91% of all rental stock or thereabouts of all Australians, right?
Yep.
The government has incentivised them through the way in which we pay tax and negative gearing and all that sort of stuff to provide rental stock, right? So they need to pay for stuff. Rents have gone up. Some people probably shouldn't be investing in property they do, but anyway, that means rents go up. That means people need to pay those rents, right?
Yep.
That makes property more attractive because the cash flow to hold it is better, so it's a better outcome for investors. And you keep getting investors investing in property to provide the rental stock that Australia needs.
Yeah.
Third of all Australians, right? You tip into that, more people coming in that need to live here, right?
Yeah.
That means rent's going to go up further. The competition for property is going to be higher. On the other side, we're not building enough, right? So that should keep this floor reasonably stable. To your point, and I don't know how this will work, where renters becoming owners of property, so first time buyers of property, makes sense when rent and mortgages end up being about the same deal, right?
Yeah.
Do they have the serviceability capability to buy that stuff, right? Therein lies the problem. So that keeps more people in the rental market, which puts more pressure on rents, which is good for property investors.
Yes.
And inherently for the value of Australian property, because then you don't have negative forces driving down the price of property,
100%.
right? We still need to build more properties, and it's a big issue. The issue is that if the government the government, state, federal, local, because they've all got their hand in, your local government for doing DA stuff, your state government for doing compliant development stuff, and federally, how the federal government incentivise people to build property, right? There's incentives that were around in COVID to try and get more building done, right? Where they give you whatever. There's always something.
All the
in there,
grants,
right? There's always something in there, right? Always something in there. Even if they said, here is the panacea for all the problems, this is what we're going to do. It's still going to take 3 to 4 years to get those properties out of the ground.
Yeah.
Because it's uneconomical to build them at the moment, right?
And
Developers go and bust.
And what's going to happen in the next, let's call it 18 to 24 months max, on top of that, where the interest rate's going to go when inflation starts coming back under control. You know what I mean? And then they start pulling them back. Again, there's that pressure on prices when it starts coming back down, especially if rents stay at that super high level. All of a sudden, the affordability is going to come down because rates are coming down. You get more people jumping in, eating up more and more rental stock on that end. Yeah. Not enough coming to market. It's going to take a while to solve this issue. It's going to take a while.
So what's the solution? Rather than the government doing different things,
I think the red tape on developing needs to really come back.
Yeah, it's horrible. They talk about it, but nothing changes.
Yeah,
and you just get these. I'm a big fan of the government, by the way, but you get sort of institutionalized boffins inside of the bureaucratic sort of engines of our state governments and the federal government, and even local government, who I don't think is really reflective or representative of the average Australian.
Yeah.
They've got. They've had really nice, safe working conditions in environments through the COVID pandemic. They're not self-employed business people.
Yeah.
They don't only get it, right? So the point, and that's okay. It's not their fault, but it means that decision making isn't always as smart as what it should be, and you get certain people making decisions which doesn't really reflect the outcome that we need, and that is we need more houses to be available for people to buy and or rent. Yeah. Yeah. You need that. That's the civic duty of the government to make that happen, because people live somewhere, right? They shouldn't be living in cars. Yeah. They shouldn't be living in tents and stuff. Like, it's absolutely ridiculous. But you can't fix that.
And I think that the tricky thing with it as well is, even if they did bring a lot of that back, it goes back to what you said before. Is it's a solution that'll be coming, but how long is it going to take to come to table as well? Because
I'm sure they'll get a committee. They'll get a committee that will, which I think they set up another committee around affordable housing, which had 10 different things. Yeah. So the committee will come up with 10 new committees to work it out, and we'll just get committee-fied.
Yeah, and by the time it finally comes through, it won't really have an effect. And this is why I'm saying, there are some solutions that can come through, or some things that can be worked to try and alleviate it, but they're all down the road. There's not much that's really going to solve an issue for now, and that's why I think this is going to exacerbate. This is going to continue to be a problem. I think there will be opportunity, especially for say first home buyers, maybe getting into the build market. I think that may start to present a bit of opportunity, especially if land prices start to come back a bit, because they're the only people that can probably hold a mortgage while something's being built. If they're living at home with mum and dad, a few of those guys might. I think a decent portion of them will take.
Maybe
that
would
avenue.
You trust the builder today, not to go bust?
We build. We still build.
Yeah, but you self-build, right?
Yeah.
But I'm talking about large house and land type developments.
No, I wouldn't.
So some builders in the hog for delivering 200 houses, right? And they're going bust, because they're
fixed price contracts.
They've been strong businesses, but they've got fixed price. But and you see the stories all the time. I've lost my $10,000 deposit, and I watched something. There was a thing on Four Corners last week, which looked at one specific building company. I can't remember the name of it. People just blowing their dough. The building industry has certain ways of I guess they call them phoenix businesses, right? Where they rise from the ashes. They go into solvency and administration. They come back and they're doing it again, right?
Yeah.
So I don't know. I wouldn't be saying to my kids, buy a house and land package at the moment, give them a fat deposit, wait for it to come online in 2 years' time. I don't know.
I do agree.
Government's got to fix that.
Yeah, I think like I've made really good money in the past from sourcing land super cheap. I think we've had a laugh a couple of times about the stuff
down the Southern Highlands way.
Yeah, I've picked up stuff like that, and I think there will be a time that will come where you can buy blocks for decent money again. I'm not talking about house and lands. I'm talking about actually buying blocks again at some point. And when you can buy those at a significant discount again, when that comes down the track, I think that'll create a bit of opportunity for these guys that can get in there at a good discount where people may have bought maybe 2 years ago, prices have gone up, but build prices have significantly gone up. Now they can't afford to hold that and try and build at the same time they hold a mortgage or another rental. That is going to create a little bit of opportunity in there. But I'm talking, it's a very small percentage of the market, but there will be some opportunity within that. But yeah, man, there's no quick, easy fix or solution for this problem. I think it's going to stay in place for a while, for a few years.
Yeah, and there's two ways to view the problem. And one is the way we've viewed it up until this point, which is this is an issue for Australia. This is hampering economic growth, the health and integrity of the population and the way they live, the happiness, the mental health of people who are struggling with it. Like, this is all bad stuff, right? And that sort of stuff is incumbent on the government to resolve it through smart policy, smart policy setting, right decision making with the right bureaucratic governance around it to make sure that Australians can advance themselves. That's a problem for government, right? That's a big issue. It's a big issue, right? It needs to be resolved. This is a podcast for property investors who want to make money out of property, simply, right? So, and I'm always conscious there's two very, very different things here, and I'm happy to talk about things separately, right? So this is an issue; it needs to be fixed. Yeah, it's a big issue; it needs to be fixed. However, property investors provide a third of all Australians the house that they live in, right? Well, 91%, right? Like, that's massive. So until big corporates come in and do build-to-rent schemes, which is how it works a lot in Europe and stuff, like, until that's still in the hands of the mum and dad investor to provide that housing stock. So the government would rather people not sit on pensions when they retire. Let's be really, really simple, right? There's a lot of moving parts here. The government would rather not pay pensions. So they would like you to be a self-funded retiree. And how do you do that? Through superannuation and also through other smart investments, aka investing property, which is probably why most people do it, right? So the government's like, number two, the government likes people transacting property, right? Because
it's pretty significant windfall for the government every time it gets transacted.
Level, you get there is a stamp duty component, which is the big chunk, and there's a land tax component, which is a big chunk. So the government is all in on property. That's all in on property, right? Which is good, right? So this being a podcast for property investing, and everything we've painted, and I think the conclusion that you have is that irrespective of all these headwinds, there's an inherent strength in the market that should propagate values as they are today and a view towards them growing into the future. And the banks have come out and pretty much affirmed that. So how do you capitalise on that? How do you, as an investor, as an average Aussie trying to get ahead in life, myself included, how do you do it? Where do you buy? What do you buy? When do you buy? And that's essentially the tactical stuff you do. So let's chat about that. Let's go to another break. Back in a moment. Welcome back. Phil Tarrant from the Smart Property Investment Show with Sam Gordon. Now, I think we've worked out that property's not going to collapse.
Yes.
You're going to put yourself on line and say it's not going to happen.
100%, man.
Yeah.
I'm not selling like crazy. I'm happy. I'm comfortable.
You're happy? You're comfortable?
Yeah,
okay, so property shouldn't collapse because of all the things we've spoken about. By the way, we're not economists, right? There's some smart people. But the banks have come out saying there should be growth ahead, and they're probably saying all the same stuff in a much more educated and erudite fashion than probably what we're saying it, right? I like to keep things easy. So, but what the conclusion was is that, okay, if you're going to invest in property, you may as well be smart about it. Smart Property Investment Show.
That's it.
How do you be smart in this market? Should you be chasing yield or should you be chasing capital growth? And where is that capital growth? Give me suburbs.
Suburbs,
regions, locations, specific addresses. That's what I want.
So I think the way I would be looking at this, I firstly take it from a macro position, right?
Yep.
What we're talking about is all the points we spoke about earlier and what we discussed earlier really boils down to your more expensive and unaffordable markets right now. This is a reason why they're not going to crash. This is what's going to hold a floor under it. Is it going to have exceptional growth in the next few years? I don't think it is. That'll hold that market, which I'm comfortable and confident in. I honestly think it will. What I'd be looking for is now all the same factors that are going to hold that market, right? That's unaffordable. If you go and apply that to, so that's unaffordable. If you go and apply those same factors and find other areas as well that also have that affordability factor, they're getting smashed from a rental perspective and population growth in that area as well. They've got projects, they've got super tight vacancy rates that are tightening even further. Even if you look in the area and it's unaffordable to build there because build costs are so expensive, it's all room for that market to continue to grow. And it really is a floor there that's going to keep pushing it up from that end as well. So I'd really be targeting that. There is a massive amount of it, mate. There's too many to even give you one region. There's just so many of them, mate. I can't even give you one. So, mate, that's what I would be looking for, is really targeting those places that still have the affordability, plus all the really strong fundamentals and dynamics that are going to keep pushing it from that front.
The point is, put your money in a market that's going to grow faster than a different market.
100%.
Yeah.
Even if like you're going through the sell down phase at the moment, I sold a few of mine at the start of 22. I could see the shift coming in there. Sydney was going to pull back a bit. I shifted a couple in that market and redirected them, put them in different markets that have been growing really well since then. Yeah. Man, I guarantee there'll be suburbs that will produce over 20 to 30% growth this year, and they'll do this. There'll be others that do the same next year as well.
Whoop or in their capitals.
Both.
Capital cities.
Both. Well, if you consider Whoop a good, strong regional centre. So we're talking big, strong regionals,
Such a
mate.
good term.
And capital cities. Yeah. There's definitely a lot of good options in there that you can really target.
So give me
and
some
capitalise
parameters
on.
then around, let's get it out of the capitals. Let's talk about, and the government's trying to incentivise people into the regions, right? And I think people have realised after COVID that the region's a pretty cool place to live, right? And you get, look, I live in Sydney, and you think Australia is Sydney. It's not. Yeah. It's out of Sydney.
Yeah,
It's where real people live.
Yeah.
But there's got to be, not all regional areas are created equal.
Yes.
So how do you, I know you're not going to give me any locations or probably even a state, but what do you look for in the regions outside of affordability to give you sense for capital growth? So point being, we're chasing capital growth now rather.
Yeah. Well, I think a strong yield a lot of the time comes with these more affordable areas because they haven't had their huge cycle yet. They haven't had their huge growth, but their markets are still under very strong pressure. So a lot of the time they still come with decent yields. Like we don't buy anything under a 5% yield. Most of our stuff is 5.5%, 6% plus,
Net
even on growth
yields.
No, still gross yields, but still on growth properties, right?
So I was going to say, mate, where are they?
Yeah, we're getting them, man, but they're a little bit more accelerated strategies with that stuff.
God.
But mate, it really comes down. You look at a lot of the key factors. You got the tight supply line, which a lot of these obviously have, like we've spoken about. Super tight unemployment figures as well. So really tight, which means it's a very strong, robust economy in the area. You got a lot of population moving into these areas as well. Got a lot of localized, both localized and bigger infrastructure projects in areas. All that good stuff that comes in that as well. One of the other big things, if we're talking to regions, like you said, is you look at the build prices in the areas and you look at the house prices. When you kind of look at that correlation, you're looking at new 4B2s as costing you over $500,000, but you can still buy existing stock in the 350, 400K brackets. There's huge room there to grow, and that will keep moving forward as well. I strongly believe too. So, there's a lot of factors that keep pushing them as well.
How do you get a competitive advantage? Are you sort of playing the game, searching realestate.com.au for assets? Is that what you do? Just going, I found this place.
Definitely not.
So how do you? Because
so in this market, with stock as tight as it is, it's all about the off markets.
What do you call off market though?
But off market something that's not on a straight up portal.
Hasn't been listed.
Yeah. So it's either direct through the agent, even like your mail out to your pre-market.
So not pre-market.
Stuff, right?
You'd call pre-market off market.
Even a bit of that stuff. We do a little bit of that stuff as well. If it comes through and you can jump on it quickly, it's still not on the open portals and getting smashed by the masses. Yeah, but the big one we obviously have is we have our agent relationships and our agent connections as getting access to that stock. And when you get access to that stuff and no one else has got a crack at it, you're taking the heat out of the transaction. So you've got a super hot market with almost no stock, and then you're getting access to this stuff. As long as the really key thing is because exactly like I know you were about to jump into there, is like off market's such a bandied around term. It's just, as long as it's off market, it's a great deal. That's a load of crap. But it all comes down to knowing the market value in that area, and then you get the deal, you get access to the deal, you can negotiate it with the heat out of the transaction. So this is just you and the seller, and you work on it, and that's how you can still,
it's
source
a good point
deal.
you make, because a lot of people think off market properties are good properties, and often, and I'll give you a hot tip, property investors, a lot of smart real estate agents' strategy is to try and get a property away off market. So they'll go, I reckon we can shift this over here through someone else. So often off market is bad property. There's something wrong with it, right? It's on the nose for some reason. And they're going, we just don't want to list this because it's going to be hard, right? So, but on the flip side of that, you often get off-market properties for other reasons. People might not want to list a property, they might want to be associated with it. There might be some pressing matter, which means they've got to move it really, really quickly. So good and bad off-market. So don't absorb yourself too much with off-market properties, because it's just another way that real estate agents sell it. Right.
There's agents that'll push for top dollar off market. They know the buyer's agents to target, or they'll see the nufties coming through and they call them about all this stuff and they send it to them. We've turned it down at, let's call it 380, and we think it's worth 400, just to give rough figures. And then you see some guy come in and pay 410, 420 off market. I think it's a great deal because it's off market. Mate, we see it all the time. We see buyer's agents do it all the time. Other BAs, and it's just, mate, it's one of those things you have to know your market intimately, and also do a good job for your client.
That's why people pay you money. Like, it's not cheap to use a buyer's agent.
Definitely not. Definitely not.
And this is the point, right? People think,
but we chatted about this back in the day when I got burnt by a BA. That's why I became one. It was because that exactly
is that your story? Is that your foundation story?
There's the rabbit farm first, and then go into
struggling rabbit farmer
gets burnt by a bastard BA.
How many? So you farm rabbits for the pellets, correct?
We weren't rabbit farming at the time. We were doing the manufacturing.
I'm just trying to think how many pelts of a rabbit would you need to create in order to? You got the right term, pelt. To get enough deposit, right? Like, but that's sort of
it was
but what I'm saying
before
but what I'm saying though is that back to the point. It's not rich people that usually, like, wealthy people invest in property, right? But back to the point around Aussie investors, mum and dad investors being the engine for making rental sites. It's people largely 100%. Just trying to get ahead, right? Like, so you talk about 10 grand, 20, that's a lot of money.
100%.
It's a lot of money. It's not like uber wealthy people throwing millions around, right? Like, these are real thought through decisions. So the responsibility of the buyer's agent to their client, to your point,
it's huge.
Is critical. So I've been knocking around buyer's agents for a decade or so. There's ebbs and flows, right? During the heady days of 2021, 2022, good luck buyer's agent getting a phone call back from a real estate agent, right? They're like, nah, I don't want to talk to you guys. Like, because buyer's agents were packaged as people that got you cheaper rates, and then buyer's agents don't always get you a cheaper rate. Like, buyer's agents usually will probably get you fair market rate for a property, right? Every now and then you might get an absolute cracker and find it because of contacts and networks and stuff, but it moves in every single market. Like, if you said, I'm only going to buy you a discounted property back in 2021, like, there weren't really any discounted properties back in 2021. It was hard.
It was hard.
Now you get this transition where you can argue it that the relevance of buyer's agents become better for the purpose of helping real estate agents shift stock because slightly less buyers, but to your original point, there's a lot less stock on the market. So this is the equilibrium that we sit in, which inherently keeps the value of real estate at the moment neutral in most markets. It's come back a little bit, but for ongoing price growth moving forward. So where you're sitting, you're on the plane a lot lately?
I'm getting around a lot.
So you're down in Sydney for today, but you're not looking at any property?
Nah, not
there
today.
You go.
I'm just down to catch up with you, mate. Not buying in Sydney, definitely not.
So give me a percentage, regional versus metro, suburbs you're buying in at the moment. So give me a sense, right? How many different suburb locations are you buying at the moment?
So I more go by councils because what we like to do is
local government areas, LGAs.
So at the moment we're in 11 different councils across the country.
Okay.
It's pretty evenly split. You probably got 6 of them are in capitals and Yeah, actually, yeah. It'd be a very even split between the two, between regions and capital cities. I like to become an area expert, so we have buyers agents on the ground in each of the different areas, and yeah, man, we become area experts there, so we know it intimately, because that's the biggest way you can get this wrong. You don't know a market well enough. You get to send a property that might look good for the suburb, but it might be in a housing commission pocket or vice versa or whatever. So it's about knowing that intimately. So yeah, man, we've got a good spread across that.
How many LGAs in Australia? I can't remember, 3,000?
I don't know. Councils?
Councils, no, LGA, local government area. I'm trying to remember. It's 15. Anyway, but 12's not a lot.
It's not a lot. No,
it's not a lot.
It's skinny. Yeah, 100%. Yeah. The one thing about regionals is normally you might have a council that's got 50, 80, 150,000 people in it, depending on the council. So, but you might buy in 12 suburbs in that council. So it's actually, suburb-wise, would be over 100 suburbs, across the country.
But say you're operating in 12 council areas, right? Blacktown Council, for example, would be one council.
Yeah.
But Blacktown Council includes,
It's a big area.
Probably 30 or 40 plus suburbs, right?
Yep.
You know, like Blacktown will be one, Marion will be one, etc. Doonside, Rudy Hill, etc.
Yeah.
So of those 12 that you're buying in, just give me some sense for it. How many of them are you buying at the start of what you think the cycle is versus halfway through the cycle versus at the back end of the cycle?
At the moment, it's a mix. We don't touch anything that I consider at the back end of the cycle. I like to always have, obviously, room for growth for our clients as well. The one big shift that came with the COVID boom is it took a lot of locations out. It took a huge amount of locations off the table because there's just so much price growth. So it limited a lot of markets to where still actually had growth potential. So again, I would go back to probably a very even split of what I spoke about before, of probably about 5 or 6 either way, that are some are halfway through but growing rapidly. So if you're jumping into those, and let's say you've got a 2-3 year window of, right, where the aim is we're buying it at 400 or 500, we're going to get to a certain amount of growth, and then when we get to when we think the market's peaking out, we're going to tap back out, take that cash, roll it somewhere else, like the profit, like the example we gave before. And then we've got other areas, so we kind of jump onto those ones, and we've got very established connections, because a lot of those markets we've been in for, some of those markets have been in for 24 months. And then we've got other areas that I kind of call them like up and comers, that I think are very early in the cycle, haven't had a decent run in, some of them 10, some of them 15 years. They haven't had a decent cycle since their last proper run. So we're positioning ourselves very early in those markets that we see are in the midst of their changes at the moment. They've got all the good stuff we were talking about before that's driving the population, but the affordability's off its head in those areas, like really strong. So depending on the investor, will depend where we put them, because some people need those quick wins sooner so they can keep leveraging, and others a mix. And some people want to hedge the bets and get in nice and early to ride the full cycle. So it always depends on the individual investor as to what they need and what they want. And then, we always just try and really help guide them through where suits them best to keep moving forward.
So what signals do you look for to tell you that it's time to stop buying in a market?
We've talked before about dumb money. Yeah.
So when you see that arriving, which means that people start overpaying for property. Yeah.
So when we see that, that's when we stop. When that comes in proper full force, that's when we stop buying. And then I just keep very, very close contact. I and constantly assessing numbers, days on market and everything as well. We keep a really close eye on it. And then we're very close with a lot of our agents, like the example before, buying in some of these markets for 2 years. We know some of these agents like good mates. Yeah. And so they're giving us like live feedback on where markets are at as well, to make the decision and make that timing of when do we exit the market correctly. And then we pretty much just get back out to all our guys and go, this is the time. If you're thinking about, selling in this cycle, this is the time to look to take it to market.
And how quickly does a market change from a buy to a hold to a sell?
It always depends on the market.
Like, could it be one weekend they go, everything's completely changed now?
It doesn't change that quick. No.
So
it takes a bit of time because it's a stock starting to pick up. Just probably people's appetite starting to ease off as well.
So when you start seeing stock on market increasing, what does that tell you?
It's slowing. There's less people.
Price growth is going to slow.
Yeah. But it still means you've typically got a window to sell towards the top. Some people we try and buy when we know we're getting kind of nearer to it as well, when they're getting to really stupid sort of heady levels as well. And you'll find points as well where people are willing to come in and they're actually budget restricted. When you start really getting towards those budget restricted sort of pricing as well, and people can't actually get further than that, higher than that as well, that's when you start getting towards that peak in there as well. So
do you see people transacting within a year on property? So you buy today, and then inverted commas, the dumb money starts arriving, and you go, it's time to get out of this. So, do you see people
Dumb money is when
True.
we stop buying.
Yeah.
So dumb money is when we stop buying, and that's normally got another 12 months of those
Okay, so you reckon
of that
12
dumb
months.
money coming in.
Okay. So you let that run, but then you want to catch the end of the dumb money, so you sell, because then it normally goes up and then just
has
drops a
that
bit.
dip.
And
Yeah.
And there's also, you probably want to speak to your accountant about that, because if you
100%.
transact within a year, you don't get any capital gains.
Yeah, you don't want to be selling
relief,
probably
right?
in a year.
Yeah, you get 50% if you hold it for a year. So this is about timing market cycles.
Yeah.
Cool.
There's a lot of different layers to it and facets to it. But man, even if like, a lot of the time, if you're buying in, especially you're buying in starts of cycles and you're trying to time that back end, I've had cycles I've bought in, I've made 130% from the bottom to when I sold at the peak. But even if you miss the top and you miss the 10%, you're still up 120%.
Yeah.
You know, we always try and buy in, even with when we're catching markets on the way through. We know we're getting a good deal on the way in. The market's still got a lot of room for growth. We're always leaving at least 50% in the tank in those markets. When we think there's about 50% in the tank, that's when we start walking away. That dumb money and that 50%.
Yeah. So this place where you're buying now, these locations where you're buying right now, how much of the price growth is the fact that nothing's really happened? Like, I'm sure you're buying in Perth at the moment, right? Like, the reason why most people are buying in Perth is because the prices today is what they were over a decade ago, right? So the argument being, well, there's been no growth for 10 years.
Yeah.
So, you know, some of these drivers means there should be growth moving forward.
Yeah.
So, you know, it's a really tough one to plan and all. Just you know, if you're a property investor going, oh, this hasn't grown for 10 years, so I should invest there.
Yeah.
That's probably folly, right? You got to look
100%.
behind. You
Yeah.
got to work out why nothing has happened for 10 years. And just because something hasn't happened for 10 years doesn't mean nothing's going to happen again for another 10 years or 20 years or 30 years. And there is markets in Australia where that happens.
I had a lot of people that didn't want to do it. The first 12 months we were in Perth, we entered late 2020. And the first 12 months, we were almost the only BAs in there at
Everyone's
the time.
going, nah, Perth's dead.
No one's touching it. Man,
Don't
I
go
had
there.
to properly sell clients, you know, on what was shifting and changing there at the time. There was about a 12-month window. No one else was there with us. And, man, we were buying prices almost for that entire 12 months. We were buying cheaper than people paid in 06 and 07.
Yeah.
Like 13, 14, 15 years almost that we bought cheaper than what they'd
crazy.
I felt sorry for them almost, like especially investors that
A
have
lot of them
held
were
that long.
property investors.
Yeah.
And this is the point. Most property investors only own between one or two properties
Yeah.
because a lot of them 15 years ago bought in Perth.
And they buy at the back end. It's the same as Brizzy, but they buy in the late 2000s and then they hold during that whole period. And this is where you've got to, when you're watching and you're timing these markets and you get that timing, you know, correct, that's where it can be massive windfalls in a very short period of time.
Yeah, there's still people holding on to properties in like Port Hedland and Mooroombah and all that sort of stuff, which they paid $700,000 and $800,000 for 15 years ago,
Crazy,
which are now still only worth $300,000, right? So if you don't always win in property, and sometimes it's best to cut your losses, but you know that's big issues. So thankfully, there's a lot more information around these days.
Yeah, definitely.
So people don't make paid investment decisions. That's good, Sam. Thanks for coming down, mate, all the way
mate.
from sunny Gold Coast.
Yeah, mate. It's a pleasure. It's always fun jumping in here with you, mate.
Yeah,
Thanks
it's
for having
good,
me
mate.
on.
Covered a lot of ground. Hopefully we're simplified in many ways, but I think the conclusion from you is if you invest in the right markets, you're probably going to get growth.
Yeah, 100%. I very, very firmly believe
You've
it.
got to work out where they are, and he won't tell anyone unless you call him up. How do people get a hold of you, mate?
Mate, so they can come straight in, australianpropertyscout.com.au. We're on all the socials, as you are aware, and thankfully, let me give it a little plug. We've got the Scouting Australia podcast as well.
Australia
That's always a
podcast.
bit of fun with Jimmy jumping on there, having a good chat. So a lot of tips and tricks, and essentially our way of investing is all over that thing. So if anyone's interested, go check
So
it
you
out.
actually give some good sound advice and information.
I thought you were going to listen to it. You told me last time we spoke you were going to listen to it.
Yeah, I listened to it for 5 minutes, and then I got a phone call. I forgot to turn it back.
What a dog. No.
No, I forgot to say no. No, it's good, mate. It's good.
No, thanks, man.
It's there's a lot of property podcasts out there, but for buyers agents, like all buyers agents are wired a bit different.
Yeah.
So you got to like your buyers agent.
100%.
It's like you got to like your accountant.
Yeah.
Like if you don't like your accountant, get a new accountant.
Yeah.
If you don't like your buyers agent, you don't get on with them.
Yeah.
You know, you don't think they're doing a good job. But inherently, if you can't communicate well with them, all that stuff, get a different one, right? So
Yeah, I
got to
agree.
find what's right for you, and you got a big spectrum of clients now, right?
Yeah,
you
it's
just
good.
don't attract the young guns. You get sort of old grizzle guys like me, sort of using Australian Property Scout as well.
Mate, we get heaps of young guns. It's good. Yeah. A lot of, I think a lot of people really resonate with, I guess, where I've come from as well. I didn't do this on a $200,000, $300,000, $500,000 income. I was never making over $100,000 a year, and build a massive portfolio off the back of it. So I think a lot of people resonate with that, and they kind of.
Do you reckon you could do that today though? Like you know, if you've got the average salary in the average Australian salary is about $65,000. The median salary is about $95,000, right?
Yep.
So if you've got an average salary, $65,000, can you emulate what you did when you did it?
Yeah.
So it's still the same.
Mate, I didn't do it
largely?
in a year. It took me to get to 20 properties, which I did on that income. It took me, I think it was 10, 11 years, something like that. Mate, I didn't do it in a
But
weekend.
that's not, people don't want to do that. They want it all today, mate.
Mate, I didn't have a holiday for 7 years. My holidays were going and renovating properties, and I saved everything I could to go renovate. People say you can't do it. You got to remember, I hit the wall and then searched for a year on how to fix it. I found the solution. I then went past it. I found that and then went until I hit the next wall. And it wasn't an overnight thing. And people say you can't do the same thing. You 100% can. You just got to be committed to it. I think what I love is I get, like you were saying before about the young fellas, you get the young guys come through and they're starting with a small amount and mate, they just trust you and they go, all right, and I'll say, okay, this is what we're going to do. And sometimes the strategy is to hit the ceiling, is to build to a certain amount. Let's hit the ceiling.
Stop.
Let the first one have significant growth, sell it off, get the debt back, get the cash back. Let's roll into some different structures and build it from here. That's literally how I did it. So
what's the lowest income you're seeing from your clients starting off in property investing? Like realistically,
probably like you get a couple.
They're full-time workers,
Yeah.
or some people like got 8 gig economy jobs.
No.
No.
I don't seem to attract the real. I don't attract you, mate. I don't attract the high rollers.
Oh, no.
But no, I get plenty of guys that are like 50 to 100,000, and then still, plenty of people that are above that. But I definitely attract a lot of people that sit in that. Mate, I had a text.
And they can do it.
Mate, I was a text I'll show you later after this. As a young fella, he bought a property it was at start of last year. He paid $220,000 for it, and it was a good deal. He only had $45K. That's all he could get him. It took us like 4 months to find this deal because he had such a tight actual capital. He only had 46K. Paid $220. He just had a bank val come in last week it was up $155K in equity.
Was he happy about that?
Oh, what do you think?
And how long?
So he bought it start of last year.
Okay.
And so he's pulled that out. He's pulling that out. He's got enough to go for 2 deals, and now we're going into the next phase.
And this is the point also. At a point in time, you got to pay it in property tax. However, if you're in the business of manufacturing equity and leveraging that and put into other assets, it can be quite a tax effective way to do it.
100%.
If you try and make $100,000 from your employer, you're gonna have to give away 40 something cents in the dollar, right? Or 38 cents in the dollar, right? You get hammered.
And it'll take you a while to do it.
Take you a long time to do it. So, it is a really good way to manufacture more money investing in property. You just got to get started and be committed to it. So if you were starting again today, you would just be doing that, which is
100%.
the same as what you did beforehand. The numbers are probably just a bit different.
Yeah. I'll be targeting good strong growth areas. Discount on the way in. That'd be the key thing is the growth area is the first thing, because if you don't have enough capital, you need that back out. Yeah. And even if you're running it and you can only get yourself to 2 or 3 properties, wait till the one that has the most growth first caps. You'd be taking a step back and going again. There's so many. That's just one strategy and way of building it forward. But if I was to go again right now, that's how I would do it. And I would just. It's a funny thing because back when BAs weren't as big 10 years ago as they are now, and I don't think they were as high quality either. There are some better players around now. I think because there was so few of them, it was a bit of a cowboy, I think, back then. And I think you go with the right person and they put you in those correct deals. We had guys that come in with 60K, we build them a 4 or 5 property portfolio in 2 years. You've got to leverage that expert as someone who's done it first. Trying to learn it yourself, it takes a long time. You got to listen to this stuff as much as you can. But if someone can walk you through it, and this isn't a plug for me, this is just me literally looking back. My first 6 years were incredibly slow, and then I started really learning stuff and it started going really quickly. But yeah, if you have someone that can literally take you down the path and show you how to do it, it's a game changer. I see how quick these guys are building it compared to how I did it. They're going to have bigger portfolios than me if they want that. But by the time they're
careful
my
what
age.
you wish for. big portfolios aren't necessarily good portfolios.
They're not. But what I mean is they have the ability to scale bigger if they want to. Not everyone wants to go stupid like us, but
I'm a struggling property investor trying to get ahead. Sam Gordon, Australian Property Scout. Thanks for coming in, mate. Thanks for making a trip down.
Thanks, man. Absolute
It's
pleasure as
good
always.
to catch up. You can go and listen to me and Sam. We do a few of these, so Go to smartpropertyinvestment.com.au. You track it down. The last one we did, where he reckons will be probably the most listened to podcast for 2023. We'll see what happens come December if he keeps the mantle of being the most popular bloke. But it's time in the market is just as important as timing the market. So
man.
Get into your podcast early in the year and you get better. Thanks for tuning in, everyone. Remember, go and check AustralianPropertyScout.com.au.
That's the one.
So it's a long URL.
Yeah,
or on the social media. You can check his podcast called Scouting Property.
Scouting Australia. Scouting Australia podcast.
Scouting Australia. Yeah. Okay, I will do some proper listening to it.
Thanks, man.
Remember, smartpropertyinvestor.com.au, social media, Smart Property HQ. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.